Hey, it's Jim, and this is FRM Part 1, topic on financial markets and products, and the chapter on Introduction to Derivatives. We'll limit our conversation today on option contracts, forward contracts, and futures contracts. I mean, after all, it is called an introduction, but this is going to prepare us for multiple chapters inside of this book and the next book, and then of course Part 2. But let me give you just a quick definition of a derivative. It's merely a security whose value depends on the value of a different security. Depends on or derived from, there you get the word derivative securities. And of course, among the most common derivative securities is a stock option. So if you buy an option on a share of stock, the value of your option depends on whether that stock price goes up or that stock price goes down. We call that stock the underlying asset. So you buy an option, which is the derivative, and then you buy the derivative on an underlying asset, like a share of stock. Now, as you look through these learning objectives, you'll see a bunch of sentences that sound like, hey, tell me similarities and differences between and among these three types of derivative contracts. And by the way, we'll go ahead and add swap contracts in a later chapter. We'll talk about who participates in this market. We'll even have an introduction on exchange traded and over-the-counter markets. But those of you who pay attention to Part 1, you'll note that we have an upcoming chapter that is going to be a good discussion on clearinghouses and exchange traded markets and over-the-counter markets. So this is once again an introduction. We're going to look at a couple of graphs, and these graphs are going to be really important as we move through the program. So let's go ahead and start with defining derivatives. Well, if you look at the banner there on the left, didn't I give you that definition? Underlying assets, then equities, bonds, all sorts of stuff. But, I'm guessing the GARP is not going to add some other kinds of options out there, at least in this introductory stage. But those of you who are professional athletes, those of you who are sports fans, you'll know that these I hope there's some former professional athletes that are watching my videos. You'll note that many of these athletes, they get an option. So they may sign a contract for 4 years, and then either the player or the owner of the team has an option for that 5th year. And that option depends on really whether or not the player has done really great things or if the player stinks. So this is a great example of the notion of derivative securities, that the value of that contract, the value of the option in year 5 depends on whether the player has performed or not. And of course, I'm guessing lots of you are movie fans out there, so there are options written on novels and other kind of books, but GARP will probably keep it to those underlying assets. Now, the cool thing here is that when you purchase some kind of a derivative security, sometimes you're going to own the underlying asset. Like you could own the share of stock and you could write a call option. But you don't have to own the underlying stock. So what happens then is that sometimes these things are used for hedging, which means we're going to transfer the risk to somebody else, or they can transform the risk from being, this much to this much, or you can even extend it. So we'll see in an upcoming slide that the majority of participants in these derivative markets are people like hedgers and speculators. How about some key features? Contractual agreement, right? It's an option contract, so it's a legal and binding contract. So if you agree to do something, like for example, if we enter a forward contract, and I'm a farmer, and you want to buy some corn from me, and you say, "Hey Jim, I want to buy 627 bushels of your corn in 2 months' time." We'll agree on a price. And it's a legal and binding contract, so that at the end of that 2-month period, I have to deliver, 627 bushels. I have to deliver, and you have to pay for it. And if not, if one of us fails to deliver, the other one can, bring in one of those people that wear, the long black robes, and you have to stand whenever he or she walks into the courtroom, and a judge will say, you're guilty. Hey, Jim, sell your farm so that you can pay off that other. Hopefully it doesn't get to that stage, but those are the consequences. Yes, whatever I win, you lose. Whatever you win, then I lose. So it's zero sum. Now you need to be careful here with that third block point. Forward contracts and futures contracts are almost free. They're very, very low cost. Options, however, depending on the terms of the option, we'll talk about that in a few minutes, they can be quite salty, or they can be 25 cents or even a nickel. So there's an upfront premium for the option, which may or may not be low. Leverage, of course, means that we're trying to magnify returns. Now that's good things if we're magnifying positive returns, but it's not so good if we're magnifying negative returns. So remember that leverage works both ways. Almost always, you think about leverage, you think about some kind of a debt position, whether it's a personal loan or a bond issue or something. But leverage in the case of derivatives, it can mean those things, but it can also mean the simple fact that if the underlying asset changes by a small amount, the value of the derivative contract can change by a larger amount. And this is especially true with options. Now, when we get to the next chapter on difference between exchange traded and over-the-counter markets, we'll see that the key word there is this idea of customization or tailorization. If you're on an organized exchange, you pretty much take whatever they give you. It's standardized. But if you go in the over-the-counter market, then you can, my example just a minute ago, what was that? 627 bushels of corn in 2 months. That was standardized to my harvest time and your time when you're going to be hungry in the future, or whatever you're going to do with those bushels. All right, I've danced around this kind of a use here. So risk management. So there's hedging. We did that. Corporations who know that they have positive net present value projects at some time in the future, like in 3 months. So a company might know that it's going to issue a bond in 3 months. Well, what's the risk? The risk is that in 3 months, the interest rates will have doubled or tripled, and we'll have to issue a bond, with a super high coupon rate. So what we can do is that we can use some type of a derivative, whether it's an option, an interest rate option, or a futures contract. We can kind of lock in that future borrowing price, and that's really super cool stuff. I love teaching that to my upper level finance students. I don't ever teach that to my introductory students because I have mostly, I have a lot of just business students, but the finance students, they can handle all this. Yeah, employee stock options. You guys know that the average CEO salary in the United States is, 4 million, 5 million, 6 million, base salary. And so that's probably reasonable. However, the Wall Street Journal reports every spring that, some of these men and women, they make 30 million and 40 million and 50 million. And most of that is from these employee stock options. So that's a different conversation. Is an individual worth $40 million if the stock price is not following suit? There's lots of underhandedness in those employee stock options, but that's probably not a conversation that we're going to have today. Capital investments and transferring risk. I hinted on it up there with the financing, and then speculation. Remember, I said you don't need to own the underlying asset. In fact, I tell my students all the time, I say, look, you guys, here's your homework assignment. Go watch Back to the Future. Go figure out how to drive 88 miles per hour and go back in time. Just go back a week and bring back a Wall Street Journal for me today. And I promise you that I could turn you into a multi-billionaire by the end of the day, just because if I know what an interest rate is, or I know what the price of oil is, or I know what the price of a share of stock or an index is, I'm not going out and buying those underlying assets, because when I show up in the floor of the New York Stock Exchange, I need a whole bunch of money. But if I show up on the Chicago Mercantile Exchange, then I'm going to use lots and lots of leverage, right? Remember I said these futures contracts are really cheap. So speculation, this is super important stuff. Now, one of the big differences between and among all of these derivative securities is their payoff. Some of these payoffs are linear, which simply means that if the underlying asset goes up by $1, then the contract changes in value by $1, whether you're on the buy side or the sell side. Now, with futures contracts, we call that short position and the long position. So remember, in a forward and a futures contract, and most swap contracts, which we'll talk about some other day, that's a linear payoff. And you'll see we're going to have a line going up like this or a line going down like that. We'll see that in just a few minutes. A non-linear payoff simply means that with an option, you have the right, but not the obligation to do something. And that do something is to buy or sell at a fixed price. And that optionality turns a linear payoff into a non-linear payoff. And once again, you'll see a graph of that here in just a little bit. Whoops, I went the wrong way. I also want to say something about the bottom line there. Requires complex pricing and risk management. Well, my wife always says, don't point your finger, but I'm going to point my finger at you guys. Look, when we get to Black-Scholes Merton and put call parity, and then, we'll do lots and lots of complex stuff in part 2. I'm going to try to convince you that it's not too terribly complex. Some of it is nearly complex, but I promise you can do it. All right, here's a good slide on exchange traded markets. So what was I saying just a minute ago? These are standardized. So for example, if I want to go to the exchange and I want to sell my bushels of corn, well, I can't sell, what did I say, 267 or was it 627? Remember, I'm a flipper there, so I can't remember my exact number. I can't do it. I've got to agree to buy or sell 5,000 bushels of corn. And these exchanges, they have standard amounts for every contract. It's 100 troy ounces of gold. It is 220,000 board feet of lumber, 42,000 gallons of gasoline. Now, of course, this was the attraction. This was why the futures exchanges were so popular. Let me give you just a quick history lesson. So if you go back to, let's say, the 1600s and the 1700s, well, there were forward contracts, but they were tailored to each individual need. So if one party defaulted, that was a big mess. So back in 1848, there were these 12 dudes in Chicago. They got together and they say, you know what? There's a lot of farms out there that are losing money and they're in danger of losing ownership of their land. Why don't we standardize these contracts? And so this was the attraction. So it's both an advantage and a disadvantage, but this is why it's so popular, because the standardization of the amount, like the 5,000 bushels, and the timing, like the third Wednesday in March or the third Wednesday in June, this standardization, it increases liquidity. In fact, there's massive liquidity on these exchanges so that you can get in and out. Look at the bottom, open outcry. They're shouting bids and offers, and they're using hand signals. Years and years ago, I took my buddy and I went to the Chicago Mercantile Exchange, and this might be 20 years ago, and so we're watching these guys and girls, and they're yelling at each other and swearing at each other, and they're frisbeeing the little the cardboard records of what's being traded. So it's super fun. Today it's not nearly as exciting, although when there's lots and lots of volatility, then it can get exciting. But the important thing here is the standardization and the simple fact that when you take the long or short position on one of these contracts, you don't really have to worry about that other party. There's a clearinghouse in there that is going to kind of guarantee, I hate doing quotes, but they kind of guarantee both sides of the transaction. So if that other party defaults, the clearinghouse will provide you with the necessary your profit. So summarize exchange traded. Yeah, so advantages, standardization, reduced counterparty risk. I just said that. Liquidity, I said that. And they're not nearly as regulated as some other markets that are out there. So what are the disadvantages? The lack of ability to custom. Now, there is a margin requirement. So on the exchange, remember I said this to you a few minutes ago, that when you take the long or short position in a futures contract, it's essentially free. I mean, you have to pay something, but they asked you to keep a margin. So both the buyer and the seller, the long and the short position, have to put up a margin, and that's kind of a buffer. So at the end of the day, when those funds are traded, then the clearinghouse has they have a safety net or a buffer. Limited product scope, right? You can't go to the floor of the Chicago Mercantile Exchange and get a futures contract on a red pen. That's probably a dumb example, but there are other examples that you can't trade. Over-the-counter markets, so these things are kind of the opposite of what we just said. There's not, did I say this earlier? I implied it, right? Chicago Mercantile Exchange, New York Mercantile Exchange. I mean, you can't be on the beach in Florida. You got to be in Chicago. So those are physical places. But the over-the-counter market, this is, you can be anywhere, and nowadays you can just have a phone, I guess. So it's decentralized. Really, you can just pick up the phone and call. Well, you're going to call an investment banker and say, hey, you know what? I need 627 bushels of Jim's corn in 47 days. And so you can go back and forth and you'll customize that contract. So look down at that blue teardrop point, much less transparent than exchange trading, small companies. It's also popular for large trades. So yeah, fewer restrictions, freedom to negotiate. So there's the customization. And it's probably cheaper than showing up on the floor of the Chicago Mercantile Exchange. The disadvantage is that we'll learn all about this in another chapter. So there's not a central clearinghouse corporation like there is in Chicago or New York. Now there are clearinghouse rules and there are clearinghouse strategies, but there's an increase in that third party or the counterparty risk. Less transparency, lower liquidity, regulatory. So I mentioned those kinds of things. Here you go. Get out your phone, take a picture of this slide because these are really great exam questions. I mean, I could probably, in the next 10 minutes, I could probably craft 10 different multiple choice questions on this table right here. All right, let's continue and our discussion from, like that kind of the forward futures contract that we were just talking about. So let's extend that to options. So I said this to you earlier. I said an option is the right but not the obligation. So you have the right to do something. So look down in the center there. If it's a call option, you have the right to buy. If it's a put option, you have the right to sell. Now, what does that mean? You have the right but not the obligation to either buy or sell. What that means is that you have the right to do something, or you have the right to do nothing. And that right to do nothing has value. The right to do nothing has value. That was worth repeating, at least I think it was. I say to my students all the time, wouldn't it be awesome if you had the right but not the obligation to come to class? There would be no penalty if you didn't come to class. You could just sleep in and be a slug all day long. But of course, there are penalties. But that's not the case with these call and put options. The right to do nothing has value. That's why what I was saying earlier is that sometimes options have tremendous premiums. So let me just give you a quick summary here. When you show up on the futures exchange, what you do is you agree to buy or sell at some time in the future. And it doesn't cost you very much money. You'll have to put up a margin. However, in the options market, what you do is you have to show up with some capital. You have to pay the writer of the option. You have to pay the creator of the option. And that's usually some kind of an investment banking firm. Now, the cool thing is that there is an asymmetrical payoff. So sometimes there's unlimited upside, And sometimes there's limited downside, depending on whether you have a call or a put. You'll see that here in just a second. The important point of this slide is that, hey, you need to pay a premium right away. It's just like going to the New York Stock Exchange and buying a share of stock. You go to the Chicago Options Exchange to buy a call option or a put option. You have to pay for it. Now, the forward market, these are all custom agreements. These are OTC contracts. And you and I, well, at least I, but I'm guessing that either you have, depending on how old you guys are, if you're in your late 20s or early 30s, you've signed an interest rate forward contract when you borrowed money to buy a house. Now, hopefully I'm not offending you guys. I'm guessing that you didn't have enough cash to buy a house. I surely didn't. So when my wife and I borrowed, however long ago that was, we've been in our house now 20 some years. We went down to the bank and we signed an agreement. We said, oh yeah, we agree to borrow this amount of money. And the banker said, that's great. The interest rate today is 5%, whatever it was. And no matter what happens between now and the closing date of the mortgage loan, you'll get that 5%. So after a month, if interest rates are 7%, I'm happy. I'm only paying 5%. But if interest rates are 3%, I'm sad because now I have to pay 5 when interest rates are 3%. There's that zero sum thing that we talked about just a little bit ago. Now, of course, forward contracts, these are going to be tailored. They're customizable, which means they don't have lots and lots of liquidity because there's no way, I shouldn't say no way, there's little chance that I could sell my mortgage if I wanted to get out of it. There's little chance that I could sell it for, 128 South Pine Street for $186,427. I mean, who could fit into those kinds of categories? So there's that middle one, counterparty risk. Each side, the banker and me, the borrower, we have credit exposure. And at settlement, what happens? I go and you never see the money. You borrow the money from the bank and they slide it over the desk over to the builder or the current homeowner. You never see that money. And of course, there are forward contracts on all sorts of underlying assets. Interest rate I just talked about, but the most common is on an exchange rate. And there we go. We have a bottom example. Futures contracts, these are standardized, right? So nothing more than standardized forward contracts. There's a clearinghouse that. Now, the other thing that these 12 dudes did back in 1848 was they said something like, you know what? In order for this to work, in order for there to be lots of liquidity, we need to give both the short and the long position, the buyer and seller of corn, right? Jim's corn. We need to have the opportunity for both of these people to get out of their contract every day. If they don't want to stay for, 2 months or 4 months or 6 months, they have the opportunity to get out. This is called daily settlement and marking to market. What happens every day is that once the trading stops, the short position wins or loses. The long position wins or loses, right? Buyers or sellers. And it's a zero-sum game. So if I lose $100, I have to pay you $100 if you're the opposite position. What the clearinghouse does is they dip into my margin, take out $100, put it into your margin account. You now have $100. What you can do is you can take out that $100 and go do whatever you want with it. In order for me to stay in the game, I have to deposit another $100. So I win 100 and you lose 100. What this does is it makes the liquidity so high. You can get in and out. You can get in and out after 5 minutes if you want to. Now, do you see how the clearinghouse is keeping track of all this stuff? But if I can get in and out and the clearinghouse is keeping track of the margins, there's not a whole lot of counterparty risk. I mean, there's still some. Of course, if we have some kind of a major financial crisis, there's going to be counterparty risk because there's always default risk out there. But sometimes it's so small that it's difficult to measure. Now, let me give you just another quick example here. I'm going to waste a minute of your time For those of you who've never seen or don't understand futures contracts, do yourself a favor and go rent. You guys don't even rent anymore. Go buy. Go to Netflix. I don't even know if it's on Netflix. Trading Places with Dan Aykroyd and Eddie Murphy. They're involved in orange juice futures contracts, and it's a super fun movie. Now it's not a G-rated movie, so there are people running around in their birthday suits, and there's some bad language in there, but super fun movie. But at the end of the movie, Dan Aykroyd and Eddie Murphy, they win a whole bunch of money from these old dudes who they wanted to take all their money from. And you get a great lesson in marking to market and daily settlement at the end of that movie. So was that worth a minute of your time? Here you go. Get your phones out. Take a picture of this. I could come up with, what did I say earlier? 10 multiple choice questions. Earlier, I come up with 10 different ones here. Now, what have we done so far? We've done a handful of these learning objectives. And so it's probably a good point in time for me to just ask you a potential exam question. Now, note, I don't give you A, B, C, D, and choices. What I want you to do is I want you to read that question there. We expect the price of an underlying asset, in this case oil, to rise. All right. So what we could do, we could go out and buy oil, right? And if it rises, long position in oil, then we win. But it's going to cost a lot of money for us to go out and buy the actual oil. But we want to limit the potential loss if prices fall, right? So if we buy a barrel of oil and the price goes to zero, we lose all that money. So we're not going to be able to limit the potential loss. So of course, when we want lots of good things to happen, but we want to limit bad things to happen, well, we need to enter into the derivatives arena. Now, the limit the potential loss, this eliminates forward contracts and futures contracts. All we need to do is decide, what do we want to do with an option? And it's the first one there. We want to take a long position. We want to buy the call option, because if we have the right but not the obligation to buy a barrel of oil at, let's just pick a number, say $100 a barrel, and the price of oil goes to 200 or 400 or 800, my gosh, we're going to win tons and tons of money. But if the price falls, all we do is lose the premium that we paid on that call option. Now, if you go down to the bottom right there, if you do a short put, there's, you might think that might be a good thing, but it doesn't meet all of those conditions. So let's spend some time talking about option payoffs, and then we'll do forward contract payoffs. So you have the right to do nothing. So the payoff, the call option payoff, the C sub T, well, we can't just put an equal sign there and say it's going to be some number. Because we have the right to do nothing, and we also have the right to do something, we're going to have two choices. If we do something, we're going to have one outcome. If we do nothing, we're going to have another outcome. That's why we have the word maximum in there, and we open our parentheses. So at the expiration of the option, we're either going to receive $0 or the difference between the stock price and the exercise price. There's the X, that's exercise price. Now note, up in the top left, this is a call option payoff. And it's probably okay for us just to focus on call options here, although we'll do some put options here in just a minute. But what are we doing? We would only buy a call option if we believed that the underlying asset, in this case a share of stock, is going to increase in value. But if the underlying stock is trading for, let's say, $200, and we thought it was undervalued, we would show up on the New York Stock Exchange and we'd have to pay $200. But we could show up on an options exchange and we wouldn't have to pay that $200. Depending on the relationship between the stock price and the exercise price, which is the price at which we agreed to buy, we may only have to pay $5 or $10 for that option. So what's the most we can win? We can win all this. What's the most we could lose? $5 or $10. So look up there. That profit is going to be the difference between the stock price when the option expires and the exercise price. So let me give you just a quick example. If we have the right to buy a share of stock at $100 and the stock is trading at $500 when the option expires, we have the right to buy at 100 when the stock is trading at 500. Well, our profit then, our payoff, I'm sorry, not our profit, our payoff is going to be 500 minus the 100. That's going to be the $400. Now, skip down to the bottom. Then we're just going to flip that over. The profits depend on whether you bought the option like we did or whether you wrote the option like the investment banker did. And so the profit is going to be the difference between what you paid originally for the option and that current option price, which might be zero. Remember, I told you a little bit ago we'd see some graphs. And those of you who follow along in the chapter, these graphs are in there as well. So if we take the long position in a call, if we buy the call option, that means we show up on the exchange and we pay for the option. Well, there's our payoff, right? It's 0,000 until the stock price gets above the exercise price. Now, in this example, we're using the notation K. We used X in the previous slide. We're using K. So we do that because sometimes chapters use X, sometimes chapters use K. Just be aware of that. K and X mean the same thing if you get to that on the exam. So what are you betting on? You're betting that the underlying asset increases dramatically in value. So your payoff goes way, way up. But notice the payoff is zero for a long time and then it's positive. So there's the non-linearity of the payoff. Now, if you're the investment banking firm and you have created this option, well, your payoff looks the same for a while, but then you're going to lose a bunch of money if the stock price is high. So there's some quick math down at the bottom. $5 we win, $5 we lose if we're long or short. Exercise price 50, stock price 55. Now, here's the put option payoff. So this is what I was saying. This is what I was hinting at earlier. So notice the maximum here, if we have the right but not the obligation to buy the share of stock, we're betting that the stock price goes up. So we just have S minus X. Here we have just the opposite. If we're buying a put option, we're betting that the underlying asset, in this case, the underlying share of stock, falls in value. Right? So that's why if you think the stock is overvalued, you're going to buy a put option. So it should be obvious that it's just going to be the opposite of the call option payoff and the put option payoff. You just flip the stock price and the exercise price. And so the profits, well, you can see that down at the bottom. Here's the put option payoff. Here are the graphs. So, of course, if you own the put option, you win when the price goes down. Now, here's a really good exam question. Notice that if you buy the call option, your slope goes up and there's nothing that it's going to bump up against, right? So if the stock price goes to 1,000 or 10,000 or 50,000 or $1 million, you keep winning if you're the owner of the call option, the long position. However, if you own the put option, if you buy the put option, you know, it keeps going up and up as the stock price falls, but it hits the vertical axis and that's where it truncates. So this is a graphical illustration of what I said earlier about the asymmetrical payoffs, that a call and a put are not exact opposites of each other. And that's just part of the asymmetricality. There's no way that's a word. And if you're the investment banker, then you have just the opposite payoff there on the right-hand side. Now, the forward contract payoff, well, this is exactly, here, let me go back here. This is exactly like that thing right there or that thing right there, but you don't have the max of 0, because with a forward contract, you are obligated to trade. Huge difference. With the option, you have the right, but not the obligation. But if you enter a forward contract or a futures contract, you have the obligation to trade. That's going to result in a linear relationship. And we'll see that right here. If you're the long position, what happens? You win as long as the underlying asset, in this case a stock, goes up in value. If you've taken the short position, you lose as long as the stock price increases in value. But notice that we're truncated the losses on the vertical axis. Now, there's a really cool relationship between and among all sorts of assets. We're going to do put-call parity at some time in the next 8 or 10 chapters. And put-call parity tells us that there has to be a relationship between the underlying asset market, like a stock market, and the option market, like a stock option market, and the credit market, like a treasury market, and then even some other markets here. But all we're doing now is that we're going to say something like, suppose that we own a long call option and a short forward option. Well, notice that we've got STs and Ks in there, and what we can do is we can add those together. And of course, ST minus ST, right? And minus K plus K, well, those cancel out, right? They're zero if the stock price is greater than the exercise price. On the other hand, if the stock price is less than the exercise price, we have a zero for the call option, and we have K minus ST, so we're left with K minus ST. But this is the exact same thing as owning a put option. It's the maximum of zero and K exercise price minus the underlying stock. So look down at the bottom here. This is super important that if you own the put, it's the same thing as owning the long position, is owning the call option and shorting a forward contract. This is called, on the right-hand side of the equal sign, this is called a synthetic long put, because what you're doing is you're taking a bunch of other stuff and you're mimicking, you're creating the same payoffs. And so arbitrageurs are very interested in this, because if there's not an equal sign in between those two, then they're going to do something in the options market and in the forward market to make them equal. So that brings us to who are these participants. Notice the last word there is arbitrageurs. We'll do that here in just a second. But I think I've hinted at this, and maybe even a little bit stronger than hinted. So a hedger is somebody who owns or who expects to own the underlying asset at some time in the future. Like if I'm Jim and I'm a farmer, well, I own the corn, and I own the cattle, and I own the oil, and I own water. Are there water futures contracts out there? Well, maybe someday there will be. As opposed to, let's suppose that I'm a hamburger guy and I want to make hamburgers. Well, I'm going to need to buy the cows. If I'm a baker, I'm going to need to buy corn from me, and sugar and cocoa and whatever else goes into a chocolate donut. So hedgers, remember this, hedgers are individuals or institutions that either own the underlying asset or who expect to demand that underlying asset for some form of their manufacturing process. So let's just take here, Jim. What was I doing? I'm growing corn. And so what's my risk? My risk is that I borrow a bunch of money and I plant the corn, and I borrow a bunch of money and I water. I borrow a bunch of money and I fertilize, and I borrow a bunch of money and I get rid of all the ticks, and I get rid of all the worms, and I put a fence up so nobody can come and steal. I spray so I can't have a fire hazard, and I don't want ants crawling. And so I spend all this money. What's my risk is that I harvest all my corn and I get to the central corn market, and there's a billion other farmers and there's billions of other ears of corn out there, and I can sell my corn for 5 cents an ear. So I come back and I tell my family, "Oh my gosh, I worked all this hard. All I have is 25 cents. You guys have to feed yourself for 25 months for 3 months, right? 25 cents for, oh my gosh." My family would say, "Hey Dad, you're not very smart. Why wouldn't you go to the exchange and enter a derivative contract so you can hedge?" So what happens is I'll enter some derivative, probably a forward contract, maybe a futures contract, could even be an option. And what I'm going to do is I'm going to lock in that future selling price. What that does is it hedges risk. And what we can do is, if the underlying assets match, like I have corn, and if Chicago has a corn futures contract, which they do, and if I'm going to harvest on September 30th, and the contract matures on September 30th, well, if the asset matches and the timing matches, I can get a perfect hedge so that I can guarantee, absent of default risk, I can guarantee that I'm going to sell my corn for some known future value. So think about how that reduces risk. What can I do? I don't have to worry about the price of corn. I can worry about the watering and the fertilizing and getting my children to get up in the morning at 4 o'clock to go out and dig and do all that kind of stuff. That's called operating risk or business risk. Now, speculators, on the other hand, these are just people out there who, they don't own the farm. They don't need corn. They don't want oil. They don't have any interest in either owning today or owning the future. But what these speculators have done is they've done a lot of work. Supply and demand conditions. They've done lots and lots of research so that they expect the price of corn to rise or the price of corn to fall, so they can take a position in a forward or a futures or an option contract that will benefit them, and therefore they don't have to go out and buy a farm, and they don't have to dig in the middle of in the evening. All they do is show up at the exchange with a small amount of money, if it's a futures exchange, and say, "Hey, I think the price of corn is going to rise. Give me 1,000 futures contracts." And then when the price goes up, they daily settle, right? They just get their money and they get out, and they make a ton of money. This is what Eddie Murphy and Dan Aykroyd did in the orange juice futures contracts. Of course, they had private information about the supply of oranges. Nobody mentioned how illegal that was during the movie, but it ends well and everyone's happy, and Dan Aykroyd is especially happy. Baba boom, there was an adult size comedy there. Now, remember that we just talked about that relationship between derivative markets. We called that the synthetic, right? And there's all sorts of synthetic securities that you can create. I mentioned that we're going to hit put call parity at some time in the next 10 weeks or so. But what can happen is, if there's a discrepancy between or among some or just two of those markets, what these arbitrageurs will do is they'll come in and they'll use somebody else's capital. They'll borrow a bunch of money and they'll go in and they'll buy something in one market, and then they'll agree to sell it at some time in the future in another market. So let's suppose I borrow $100 and I agree to pay 10%. So in a year, I got to pay $110. Well, I'm going to go out and I'm going to buy a bunch of an asset. Maybe it's corn. And a year from now, if I can lock in to sell it for $120, oh my gosh, think of that. So I sell it for $120. I take the $110 and I pay off my loan and I have $10. That's called an arbitrage profit. And there's another example there of 50 million to buy euros. Now let's go ahead and be more specific with some examples with the graphs that we did just a little bit ago. So notice the learning objective: calculate and compare payoffs from hedging strategies. All right. Let's go ahead and apply those graphs that we looked at just a few minutes ago to some actual numbers. And let's do it in hedging here. So what does the learning objective ask us to do? Yeah, payoffs from hedging strategies. So there's a good definition for a forward hedge. I said this just a minute ago. What we're going to do is we're going to just lock in a future selling or a future buying price. We use the notation K here. A long forward hedge simply means that we're going to be the buyer to protect against a price increase. If I'm a bakery and I need corn, what am I going to do? I'm going to take a long forward hedge, because what I want to do is if the price of corn goes up, I'm going to have to pay more for one of my inputs. Well, a long forward hedge will pay off. And what that will do is that will reduce the future cost, the future expense of my corn. Short forward hedge is just the opposite. That's if I'm the farmer and I agree to sell at some price in the future. There we go. Perfect hedge. This is, what did I say just a minute ago? It's when the assets in the spot and forward markets are identical, corn and corn, and if the harvest date matches the date of the maturity of the forward contract. And so what the chapter does is says when the exposure and the hedge notional values are equal, and so that's a different way of saying pretty much what I said earlier. Gains and losses, there's that zero sum. So the long forward and the short forward, those are just opposites of each other. So we've got spot price today, forward price of 105. All right, so if the price at maturity is 110, the long gains 5 and the short loses 5, right? The long is betting that the price goes up. So it went from 100 to 110, but we had agreed to trade at 105. So there's the $5 on either side. Let's move to an example with exchange rates. So here we have a U.S. company that's expected to receive 10 million pounds in 6 months. So what risk is this U.S. company exposed to? The risk, we call that currency risk or exchange rate risk, is the simple fact that in 6 months, maybe we'll receive that 10 million pounds and we'll convert it back into U.S. dollars and we'll only get $4 million or $5 million or $6 million or some low number because the exchange rate moved against us. Well, one way to protect against that adverse movement in exchange rates is just to enter a forward contract. And what we're going to do is we can lock in that exchange rate. We can lock in the future value of that 10 million British pounds. All right, so the exchange rate, current exchange rate, we call that the spot rate, is 1.32 pounds per dollar. US dollars per pound. And look at the next block point there. There's a forward contract that's available at just $1.3 per pound. Now, let me say something really quickly about that. Where did we come up with that 132? Well, those depended on supply and demand conditions, current supply and demand conditions of the US dollar and the British pound. That forward rate of $1.3 per British pound, that also reflects supply and demand conditions, but not today's supply and demand, but the expected supply and demand in 6 months. It also reflects the differences between inflation of the two countries, the differences in interest rates between the two countries, and the differences between expected imports and expected exports. We'll have great conversations about how you compute that forward price some other day. So just for now, remember basic economics, that of course it makes sense that if we're going to agree to buy or sell British pounds in the future, that future price, that forward price, is probably going to be different than the current spot price. All right, so if we enter this forward contract, US-based company, we enter this forward contract, what we're going to do is we're going to agree to sell those 10 million British pounds. Well, to get the amount, all we need to do is multiply the 10 million pounds times $1.3 per pound. Remember that per, that puts the pound in the denominator. So you have a numerator and a denominator of pounds. They cancel, and you're left with 10 times 1.3, and you get 13 million. Now, let's compare that. Let's compare that against a non-hedged position. Suppose that we do not hedge and the exchange rate in 6 months turns out to be $1.25 per British pound. Notice we went from 132 down to 125, so the US dollar got stronger. So as a US company, that's going to hurt us. We're only going to receive $12.5 million. Do you see the sense of currency risk? The value of the hedge position is that we've locked into that 13 million. Now let's look at that second target point. What we're going to do is we're going to hedge the position, which means that, recall that we agreed to sell those British pounds at 1.3. But if the rate turns out to be 1.35, what that means is that we are on the losing end of the forward contract, which means that we're going to lose $500,000. We're going to exchange our 10 million in the spot market at 135, which would get us 13.5 million, but we're going to lose in the forward market, and that's going to get us back to the 13 million. So regardless of whether the exchange rate goes above 1.3 or below 1.3, there's going to be a loss or a gain in the derivative market that's going to lock in to get us back to that 13 million. Now, hedging with options, it's even more fun. Flexible hedges, right? Protects against downside but allows upside. Let's see, if we own a call option, it's going to protect short positions from price increases. If we own the put option, it's going to protect long positions from price declines. But remember that we have to pay the option premium up front. That's why it's called an option premium. So if you go back to this example, notice that we just have the S minus K or the K minus S. Here, we've got the zeros in there, and then we need to consider the P or the C, which is the price of the call or the price of a put. So there's a quick example down at the bottom. We've got a put option. The exercise price is 100, and the price of the put option is 4. So if the stock price falls down to 90, then our payoff is, well, what did we do? We bet that the price falls, so 100 minus 90. So that's a good thing. But then we have to subtract out the $4 that we paid for the put. So there's our payoff of plus 6. And then if the stock price goes up, well, then this is no good. Then we lose that $4. Premium loss only. So in that second example, there's the right but not the obligation. So if the stock price falls, we exercise the option and we sell the stock for $100 when we could have sold it for 90, right? But if the stock price goes up, we just do nothing. We allow the option to expire and we lose the premium only. So that's the nature of hey, you can have lots of gains, but you can have just minimal losses. Now, speculation with a forward contract, or in this case, a futures contract, this is going to be symmetric. This is going to be just a line. All we're doing is betting on the price of the underlying asset. So if you look down at the bottom, we've got a forward price of 100. If the price is 110, well, the long position gains $10. If the price is 90, the long position loses 10, but the short loses 10 in the first example and gains 10 in the second example. Now, one of the interesting things about these futures markets is that you have to do this every day. It's not like you can just wait until the very end like we could in the option contract, because you're going to be characterized by daily settlement and marking to market. So that long gain and the long loss, that's really on a daily basis. Now, speculation with options is going to be similar because it's a derivative security, but it's going to be completely different because we're going to have a kink in our line. So notice if we own the call option that when the stock price, if this is an underlying share of stock, when the stock price is equal to the combination of the exercise price plus the price of the call option, right? Can you see that top graph? There's the arrow, the break-even point. That's when we start winning money. If it's less than, well, we keep losing until we lose the entire premium. So that kink down there, that's where we lose the entire premium. So if we buy a call option and the stock price falls below the exercise price, we're going to lose that premium. So we really don't care. We don't care if the stock price is $2 or $7 or $27, as long as it's less than the stock price. Our losses are not magnified. Our gains can be magnified, but our losses cannot. So the long call, there's the red part of the graph, and then there's the green part. And then if the short call, you just do the opposite. How about a potential exam question? All right, we're bullish, which means the underlying asset is expected to rise. We cannot tolerate margin calls, so that wipes out all of the forward and futures contracts or open-ended losses. And so what we're probably going to do is pick one of these derivative contracts, and we'll probably just pick, well, you tell me, how about if I pause and I might look around and you guys, so think about this. We don't like the forward or the futures. We're bullish, so we expect the price to go up. We don't want open-ended losses, which means that we don't want the forward. We already eliminated the futures contract and the forward, but we don't want open-ended losses. So we'll do the long call. All right, I've hinted about arbitrage. I've actually given you an example here. Prices of similar assets are set at different levels or different amounts. So remember, an arbitrage profit, this is where you don't have to use any of your own money. We call that no investment. You don't take any risk, and you expect a positive return. That's an arbitrage profit. So what you do is you borrow a bunch of money and you make an investment, and then that investment pays off, and then you return the loan plus interest, and you make a bunch of money. All right, so let's look at a quick example down here. We have a stock that's trading at two different levels on two different exchanges. What we can do is we can buy one share on exchange B, and we can sell it on exchange 2 for a profit of $2. Now that's without any outlay of cash, because in this simple example, we're just assuming that you're trading on A and B at the same time. But I mean, imagine if you're doing this at the same time, that you're not going to be the only one doing it. So that thing will never exist. And that's why we have short-lived, because of the nature of efficient markets. But let's suppose that you're not immediately available to trade on both of these things. Well, what you can do is borrow a bunch of money and buy at 198 on one exchange. And then, well, you can do whatever it takes to sell on another exchange. And you might use an option. You might use a forward contract or a futures contract. So there's lots and lots of arbitrage opportunities out there. So let's go ahead and end with a couple of kinds of risk here. So market risk, yeah, if we're a speculator and we're betting on directional, then what if we're wrong? Counterparty risk, sometimes there's lots of default risk, sometimes there's hardly any default risk. I said that earlier. Liquidity risk, when you're on the organized exchanges, there's not too much concern about liquidity because there's tons and tons of people out there. If you're in the forward market and maybe some of the options market, you might have liquidity issues. And what the chapter focuses on is bid-ask spreads, so they could be pretty wide. Operational risk. Remember, this was a definition that GARP gave us all the way back in Book 1, Chapter 1. There's some examples inside the chapter of traders who are doing all sorts of things that they shouldn't be doing. And then fraud. So that takes us through all of the learning objectives. Once again, the best questions from this particular chapter are the potential questions that we covered, so that you get a sense of, bearish versus bullish and all of the different characteristics. If you can answer those questions, you pretty much hit all of those learning objectives. Also remember that this is pretty much a ground framework for future chapters. So this is super important, not just for the content in and of itself, but for what we're going to do with it in the future. So make sure you spend some good time understanding and covering all of these learning objectives. My suggestion is to go to the end of this chapter. There's 20 really, really good questions that will get you up to date. So, hey, thanks for watching. And as always, good luck studying.